Hi everyone, welcome to Value. So today we're going to look at Katapult Holdings. This is possibly the cheapest buy now pay later stock in this space because it is trading at $1 billion, and last year it did $250 million in revenue. So it only trades about 4 times what they did last year. Never mind, this year they have about a $450 million midpoint guidance for what they expect in revenue. So they're trading just slightly above 2 times what they expect this year, which is insane, right? This is a company that is in the high growth, really trending buy now pay later space, yet it trades at such a low valuation. And possibly it is the reason that it was a company that merged with a SPAC. So back in December it announced it's going to merge with a company called Finserv Acquisition Corporation, and that only recently just happened. So it is a very newly listed company that a lot of people probably aren't that aware of. So hence why the billion valuation, because if we compare against a company like a firm trades at 18 billion valuation, yet it only has about 3 times more revenue than what it did last year in terms of comparing Catapult to a firm. So a firm's about $250 million. Catapult's about 250 million revenue, and a firm's about 760 in the last trailing 12 months. So we did like a third of what a firm did. This company technically should have about a 6 billion valuation. Never mind the higher growth. Catapult achieved in the first quarter this year of about 88% in terms of growth. So that's much higher than a firm's doing something like 50-60% growth right now in the last trailing 12 months, whereas Catapult's done 88%, and that they achieved $80.6 million. So that's extremely good. The growth is much better. So like no matter how you benchmark it, the statistics just kind of speak volumes in terms of comparing Catapult with a firm. Yet a firm trades about 18 times higher than Catapult, which is kind of an insane metric because like Catapult just is so under the radar that it's just impossible to resist such a company that's so undervalued. And you'd hope with time and results that this company valuation will increase. It does serve a non-prime credit kind of customers, so potentially that's seen as a little bit more riskier than the other kind of companies in the space. But still, like, even if we did like a, and say like they didn't trade at 6 billion and say they trade at half of that of like 3 billion, that would still produce a $30 per share kind of valuation, which is not at the moment. And just never mind that a firm's not a profitable company, whereas Catapult is a profitable company. Catapult achieved a net income of $8.1 million. So we have a company that's profitable, growing quicker, and yet, like they're trading at such a low valuation. I'll take you back to the presentation that they released when they were announcing their SPAC merger. They expected 250 million for 2020, and then $455 million in 2021. 6 months later, they're on track to produce those numbers. They were very good with their estimates. And if they are good with their estimates next year, they could be on track for around that $800 million mark. So this is a company that does not expect to slow down in growth. And in 2023, they expect to break $1 billion in revenue. So 2 years later, they expect to do more revenue than what their market valuation is worth right now, which is $1 billion. So it's a matter of fact of, hey, if you believe in this company and the first quarter results speak volumes, revenue $80.6 million for the first quarter, 88% up, net income $8.1 million, 120% up. So if you're to look at these numbers, they speak volumes and they're incredibly good. So it's just a matter of fact of if you hold for just like, say, like 2 years, and they go to $1 billion in revenue guidance, there's no way this company just trades this lowly for this long. But markets can be irrational, of course. So it's a matter of a patience type of situation. Of course, the share price has not done well recently. It went from like $14 all the way to $10. It is a big. The stock is shorted, as well. So a lot of people, for some reason, want to bet against the stock. So yeah, like we have a really, really cheap stock in terms of the buy now, pay later space. So yeah, I think this is something worth looking into, worth researching, because if we were to compare against a company like a firm, it's insanely cheap. And if we were just to compare against growth companies in general, it is really, really insanely cheap. So yeah, like if we were to just look at companies in general and do just a benchmark, $3 billion for this company would be like very, very fair in terms of valuation, and it trades much more below that. So this is why I think this is a company that's worth looking at. Not to mention that originally when they were listing, they were doing like a comparison and against all the other companies in this space. They think what they do is really unique in terms of that they focus on a non-prime customer, they're e-commerce centric, and they're high growth. The other company that's comparable is Kplt, which is listed in the ASX. And this company also trades well above $1 billion, and had very, very similar revenues. But yeah, like we can just kind of look at this, and I can look at Kplt, just for a quick benchmark. So this is in Australian dollars. And if we look at the financials, you saw it there, ladies and gentlemen, $76 million in the for 2020, $76 million. And we look at Catapult, and they achieved $250 million. So never mind that the revenues a lot higher. So Kplt's achieving higher growth rates, of course. Compared to 2019, 2020 was about 3 times what they did, but those are extremely small numbers. And yet Kplt trades at a $1.6 billion in terms of Australian dollars, which is more or less very similar to that $1 billion mark that Catapult trades at if we were to compare the US dollars. So never mind that Catapult has higher revenues, extremely good growth. It's just kind of one of those companies I think that suffered because they merged with a SPAC and is not very well known. But I think in time, as they produce extremely good results like these ones, and they have their revenue guidance of about 425 to 475, and they are going to be an extremely profitable company. So adjusted EBITDA is $50 to $60 million, and if we were to compare against what they expected, slightly lower than their expected EBITDA of $70 million that they were expecting for 2021, and they were expecting about $47 million. So it might be slightly below that 47, maybe around $40 million for net profit this year, which is still extremely good for a company in this space growing so quickly. And it's able to, at the minute a company is profitable, it's able to fund its own operations. You don't have to worry about it trying to raise more money. Because recently it already has raised. It's already gotten about $150 million in committed capital from its investors, which is led by Tiger Global. So like if we can look at a company like this, and like all directions point towards a very undervalued company that is definitely worth looking at. Alright, until then, good luck investing everyone, and I will see you next time.